Now, moving on to our session 4A. Our speaker for this session is Lisa Oddo. Now, Lisa is a solicitor at the boutique law firm Panellist & Associates. She practices in the areas of super and tax and has been involved in many limited recourse borrowing arrangements with SMSFs since 2007. She has developed a high level of expertise with limited recourse borrowing arrangements and has worked with many accountants, financial planners, with the major banks and financiers in the implementation of these arrangements. Lisa also regularly presents on limited recourse borrowing arrangements to professional associations and small accounting firms and financial planners. I'd now like to invite Lisa to the lectern to commence her presentation, and can we all please welcome her in the usual way. Thank you.
Thank you for that, Nick. Okay, so this session is in relation to limited recourse borrowing in practice. The ability for self-managed super funds to be able to purchase property via borrowing was first introduced in 2007, and they're now known as limited recourse borrowing arrangements. They used to be called instalment warrants, but that's since changed. As Nick has said, I have been involved in implementing many successful limited recourse borrowing arrangements, but I've also been involved in being asked to rectify a lot of these arrangements that have unfortunately gone wrong for some other self-managed super funds. There is a lot of information out there for us to understand how these limited recourse borrowing arrangements work, but what I'm focusing on is really how it works in practice. So that if you are thinking of implementing one of these strategies for your clients or for yourself, or you're involved in them, that we get them right from the outset, because getting them wrong unfortunately has devastating consequences for our clients' retirement savings. So the way I'll just start off is quickly going through the typical structure. A lot of you here may have already implemented these types of arrangements, so you would this is just confirming what you already know. Some of you might not, so I'll just do that anyway. So the typical structure is that, and this is the way that I like to draw it, is that we have a self-managed super fund, and the self-managed super fund borrows from a lender on a limited recourse basis. That lender can either be a financial institution, or it can also be a related party of the super fund. The lender then takes a mortgage over the property, and just stopping there, that is a very straightforward arrangement, those three connections, and most of our clients would be familiar with that, because that's set like a standard home loan would just be three parties. What makes limited recourse borrowing arrangements difficult, I guess, when explaining it, is that we then have to explain the purpose of this bare trust. And the bare trust is there because the law says that the property that the super fund will be acquiring via the borrowing needs to be held on trust. And so we've developed this trust which we call a bare trust. Some might call it a custodian trust, but it's simply a trust that is, the purpose of it is to hold legal ownership to the property, and the super fund is the sole beneficiary of that trust. As you will see, the bare trust is also the landlord, so in a lease arrangement, it's the bare trust that's on the lease. In terms of movement of funds, you will see that there are no connections to the bare trust, because the bare trust has nothing to do with the movement of funds. In fact, it shouldn't have a bank account, and there shouldn't be any TFNs or ABN registrations or tax returns. So really, for the purposes of explaining it to our clients, the bare trust does nothing more but hold legal title to the property. And as you'll see, the tenant will pay the rent directly to the super fund's bank account, and the super fund will then pay the interest and principal to the lender, pay the expenses, and also collect the contributions. And the taxing point, according to the government, which in fact there's a bit of a problem with the law, but the government has said, and the ATO has also confirmed, that they will tax the super fund and not the bare trust on any income. And lastly, once the loan is paid off,